Passive income is a fantastic way to build financial stability and freedom, offering you the ability to earn money with minimal ongoing effort. With technology and innovative platforms advancing every year, 2025 presents unique opportunities for creating passive income streams that are accessible to more people than ever before. Whether you want to make a little extra money each month or build an income stream that can grow into something substantial, the following passive income ideas are worth exploring. These options range from low-cost investments to ideas that require time up front but have the potential to pay off handsomely in the future. One of the most popular and effective ways to generate passive income in 2025 is through investing in dividend stocks. Dividend stocks are shares in companies that pay out a portion of their earnings to shareholders on a regular basis, usually quarterly. Large, established companies in sectors like consumer goods, utilities, and finance are known for paying reliable dividends. By investing in dividend stocks, you earn a portion of the company's profits just for being a shareholder. If you reinvest your dividends, you can benefit from compounding returns over time, which can help build significant wealth. This strategy does require an upfront investment, but over time, dividends can become a consistent source of income. With the wide variety of online brokerage platforms now available, investing in dividend stocks has never been easier, and with tools like robo-advisors, you can even have your portfolio managed for you. Another way to earn passive income is by investing in real estate. Traditionally, real estate investing required a lot of capital, but thanks to real estate investment trusts, REITs, and crowdfunding platforms, you can now start investing in real estate with as little as a few $100s. REITs are companies that own, operate, or finance income-producing real estate across various sectors, including residential, commercial, and industrial properties. They pay out dividends to shareholders based on the rental income generated by their properties, making them a solid passive income source. Additionally, real estate crowdfunding platforms allow you to invest in specific properties or projects alongside other investors, providing an opportunity to earn passive income without the hassle of managing properties yourself. Real estate is known for its stability experiences, major life decisions, and, for many, the first time managing money independently. These years are critical because the financial habits you develop can set the stage for the rest of your life. Unfortunately, there are some common money mistakes that people often make in these early years, which can have long-lasting impacts on their financial health. By learning what these mistakes are and how to avoid them, you can make smarter financial decisions that build a secure and prosperous future. One of the most common money mistakes in your 20s and 30s is not having a budget. Budgeting might seem restrictive, but it's actually about giving yourself control over your money and ensuring that it's going towards what matters most to you. When you don't budget, it's easy to overspend, leading to debt and missed savings opportunities. Many people in their 20s or 30s don't track their spending, thinking they'll be fine if they don't go overboard. But even small purchases add up, especially when they become routine. The key is to be aware of where your money is going, allocate amounts for essentials, and set aside some for savings. When you create a budget and stick to it, you gain control over your finances, which is essential for achieving long-term financial security. Another significant mistake is not building an emergency fund. Life is unpredictable, and unexpected expenses, like car repairs or medical bills, can happen to anyone. Without an emergency fund, you might end up borrowing money or relying on credit cards, which can lead to debt. An emergency fund is like a financial safety net, giving you peace of mind and protection against life's uncertainties. Ideally, you should aim to save 3 to 6 months' worth of living expenses. It might seem difficult to save this much, but even putting aside a small amount each month can make a big difference over time. Having an emergency fund means you won't have to dip into your long-term savings or go into debt when unexpected expenses arise. A third common money mistake is accumulating high-interest debt, particularly through credit cards. Credit cards can be useful tools if used responsibly, but they're also one of the easiest ways to get into financial trouble. Many people in their 20s and 30s fall into the trap of spending more than they can afford, resulting in a high balance they can't pay off right away. Credit card debt is particularly dangerous because of the high interest rates, which make it harder to pay off the principal balance. It's essential to use credit cards wisely by only spending what you can afford to pay off in full each month. If you're already carrying a balance, try to pay more than the minimum payment to reduce your debt faster and avoid additional interest charges. The next mistake to avoid is neglecting retirement savings. Retirement might seem a long way off, but the earlier you start saving, the more time your money has to grow. Thanks to the power of compound interest, small contributions made in your 20s and 30s can grow significantly by the time you retire. Many people delay retirement savings, thinking they'll start later when they have more income. However, starting early is key to building a substantial retirement fund. If your employer offers a retirement plan, such as a 401k, try to contribute at least enough to get any company match, which is essentially free money. Even if you don't have access to a 401k, consider opening an individual retirement account, IRA. Contributing consistently, even if it's a small amount, will make a big difference over the long term. Another pitfall is not investing or being overly cautious with investments. While saving money is essential, investing is what allows your money to grow over time. When you avoid investing out of fear of losing money, you miss out on the opportunity to build wealth. Stocks, bonds, mutual funds, and real estate are common investment options, each with its own risk and return profile. It's essential to educate yourself about investment options and start with something that matches your risk tolerance. Many people start by investing in low-cost index funds, which provide diversified exposure to the market. Over time, regular investments, even in small amounts, can grow significantly thanks to compound growth. Remember, the goal of investing is not to make quick money but to grow wealth steadily over time. Failing to set financial goals is another mistake that can lead to poor financial decisions. Financial goals give you direction and motivation, helping you make choices that align with your long-term vision. Without clear goals, it's easy to fall into a pattern of spending without purpose. Start by setting both short-term and long-term goals. Short-term goals might include saving for a vacation or paying off a credit card, while long-term goals could be buying a home or achieving financial independence. Write down your goals and track your progress. Setting financial goals makes it easier to prioritize your spending and focus on what truly matters, ultimately leading to a more secure financial future. Another common mistake is lifestyle inflation. As you start earning more, it can be tempting to upgrade your lifestyle, buying nicer clothes, dining out more frequently, or moving into a more expensive apartment. While it's okay to enjoy the rewards of your hard work, be mindful of how quickly lifestyle inflation can erode your savings. Try to maintain a balance between enjoying your income and saving for the future. One strategy is to increase your savings rate each time you get a raise. For example, if you receive a 5% raise, consider putting an additional 2 to 3% towards savings. This approach allows you to enjoy a portion of your increased income while still building financial security. Failing to insure yourself adequately is another mistake people in their 20s and 30s often make. Insurance might feel like an unnecessary expense, especially if you're young and healthy, but it's a crucial part of financial planning. Health insurance, disability insurance, and renters or homeowners insurance can protect you from substantial financial loss if the unexpected happens. Medical bills, accidents, or natural disasters can result in significant expenses that can drain your savings or push you into debt. It's worth investing in adequate insurance coverage to protect yourself and your finances. The peace of mind that comes with knowing you're covered is well worth the cost of premiums. Impulse spending is another habit that can derail your financial progress. With online shopping and easy access to credit, it's all too easy to buy things on a whim. While occasional treats are fine, frequent impulse purchases can add up quickly and impact your budget. Try to adopt a wait-and-see approach before making non-essential purchases. This means taking a few days to consider if you really need or want the item. More often than not, you'll find that the initial urge to buy fades. Practicing mindful spending allows you to make purchases that truly add value to your life while keeping your financial goals on track. Finally, not learning about personal finance is a mistake that can have lasting consequences. Financial literacy is essential for making informed decisions about your money. Many people avoid learning about finances because they find it overwhelming or assume it's too complicated. However, there are countless resources available, from books and online courses to podcasts and blogs, that can help you improve your financial knowledge. Understanding basic concepts like budgeting, debt management, investing, and tax planning will empower you to make better choices and avoid costly mistakes. Taking the time to educate yourself about personal finance is one of the best investments you can make in your future. Avoiding these common money mistakes in your 20s and 30s requires discipline, awareness, and a commitment to building good financial habits. While it's normal to make some mistakes along the way, being proactive and mindful about your money can help you build a solid financial foundation for the future. Remember that financial freedom doesn't happen overnight. It's a result of consistent, smart decisions over time. By budgeting effectively, saving for emergencies, managing debt, investing wisely, setting clear goals, and avoiding lifestyle inflation, you can set yourself up for a secure and prosperous future. Taking control of your finances now will give you greater freedom, flexibility, and peace of mind as you move forward in life. Cryptocurrency has revolutionized the world of finance, creating a new way to think about and handle money digitally. But for many people, the concept of cryptocurrency remains mysterious and intimidating. This beginner's guide will break down cryptocurrency into easy-to-understand concepts, helping you to understand what cryptocurrency is, how it works, and why it has become such a significant part of today's financial landscape. Whether you're curious about Bitcoin, Ethereum, or any other digital asset, this video will give you a solid foundation to start exploring the world of crypto. Cryptocurrency is a digital or virtual currency that uses cryptography for security. Unlike traditional currencies issued by governments and central banks, cryptocurrencies operate on a decentralized network of computers known as a blockchain. This blockchain is a digital ledger, which records all transactions and is publicly accessible to ensure transparency and security. Bitcoin, created in 2009 by an unknown person or group using the name Satoshi Nakamoto, was the first cryptocurrency, and it remains the most well-known and widely used to this day. But since then, thousands of other cryptocurrencies have been created, each with unique features, purposes, and uses. So, what exactly is cryptocurrency, and how does it work? Imagine that cryptocurrency is a form of digital cash, designed to be secure, fast, and easily transferable across the internet. It allows individuals to send or receive payments without needing a traditional bank or financial institution. This is possible because of blockchain technology, which serves as the backbone of all cryptocurrencies. A blockchain is a decentralized database managed by multiple participants, known as nodes. Each block on the chain contains a list of transactions, and once a block is completed, it's added to the chain in a linear and chronological order, hence the name blockchain. One of the main reasons people are drawn to cryptocurrency is its decentralization. Unlike traditional currency, which is controlled by a central authority like a bank or government, cryptocurrency is decentralized. This means there is no single entity in control, and the power to manage and regulate the currency lies with the network participants themselves. Decentralization has its benefits, primarily security and transparency, as transactions are recorded on a public ledger and verified by a network of computers. Since there's no central authority, it's much harder for any single entity to manipulate or control the currency. When we talk about cryptocurrency, we often hear about two main components: coins and tokens. Coins are cryptocurrencies that operate on their own independent blockchain, like Bitcoin or Ethereum. They are generally used as a store of value or a medium of exchange. Tokens, on the other hand, are cryptocurrencies that are built on top of an existing blockchain, like Ethereum. They are often used to represent assets or for specific functions within a project. For example, Ethereum allows developers to create tokens that operate on its blockchain for various decentralized applications, known as dApps. Bitcoin, the first cryptocurrency, was created with a specific goal in mind: to provide a decentralized alternative to traditional currency. It was designed as a peer-to-peer electronic cash system, allowing people to send and receive payments without a middleman. Bitcoin's primary purpose is as a store of value, and it's often referred to as digital gold because of its scarcity. There will only ever be 21 million bitcoins in existence, which gives it a level of scarcity similar to gold. This limited supply has made Bitcoin a popular investment, as its value is expected to rise over time due to its rarity. Ethereum, the second largest cryptocurrency, was introduced in 2015 by a young programmer named Vitalik Buterin. Ethereum is more than just a currency, it's a platform that allows developers to build and run smart contracts and dApps. Smart contracts are self-executing contracts where the terms of the agreement are directly written into code. This means that transactions and agreements can be made directly between parties without the need for a third party. Ethereum's versatility has made it the foundation for thousands of other tokens and projects, creating a vast ecosystem of decentralized applications. Now, let's talk about how to get involved in cryptocurrency. To buy and sell crypto, you'll need to use a cryptocurrency exchange, which is an online platform where you can trade digital currencies. Some popular exchanges include Coinbase, Binance, and Kraken. Each exchange has its own user interface, fees, and available coins, so it's essential to research and choose an exchange that suits your needs. Once you've set up an account on an exchange, you can link your bank account or credit card to purchase your chosen cryptocurrency. It's worth noting that cryptocurrency prices can be highly volatile, so it's important to only invest money that you can afford to lose. Once you own some cryptocurrency, you'll need a place to store it, and that's where wallets come in. A cryptocurrency wallet is a digital tool that allows you to store, send, and receive your digital assets. There are several types of wallets: hot wallets, which are online and connected to the internet, and cold wallets, which are offline and offer an extra layer of security. Hot wallets are convenient for frequent trading, while cold wallets are better suited for long-term storage as they are less susceptible to hacking. Some popular wallet options include software wallets like Trust Wallet, hardware wallets like Ledger and Trezor, and even paper wallets, where you write down your private key on a piece of paper. Speaking of private keys, it's crucial to understand the concept of public and private keys in cryptocurrency. When you own cryptocurrency, what you actually own is a private key, a unique code that allows you to access your funds. A public key, on the other hand, is like an address that others can use to send you cryptocurrency. Think of your public key as your email address and your private key as the password to access your email. It's essential to keep your private key secure and never share it with anyone, as losing it means losing access to your funds. Cryptocurrency transactions are processed and verified by miners or, in some cases, validators. Mining is the process of adding new transactions to the blockchain and involves solving complex mathematical problems. Miners use powerful computers to solve these problems, and when they successfully add a block to the blockchain, they're rewarded with cryptocurrency. This process is called proof of work, which Bitcoin uses. Another consensus mechanism is proof of stake, used by Ethereum 2.0, where validators are chosen based on the amount of cryptocurrency they hold. Both mechanisms ensure that the blockchain remains secure and that transactions are legitimate. You might have heard of terms like ICOs and NFTs in the crypto space. ICO stands for Initial Coin Offering, a fundraising method where new cryptocurrencies sell a portion of their tokens to raise capital. It's similar to an IPO in the stock market. NFTs, or non-fungible tokens, are unique digital assets that represent ownership of a specific item or piece of content, like art, music, or virtual real estate. NFTs are bought and sold on blockchain networks and have become a popular trend, especially in the art and entertainment industries. Security is a significant concern in the cryptocurrency world. While the blockchain is inherently secure, exchanges and wallets can be vulnerable to hacks and fraud. To keep your crypto safe, it's essential to use reputable exchanges and wallets, enable two-factor authentication, and be cautious about phishing attempts. Scams and fraudulent schemes are common, so it's crucial to research any project or investment opportunity thoroughly. Remember, if something sounds too good to be true, it probably is. Cryptocurrency regulations vary widely from country to country. Some governments, like Japan, have embraced crypto, creating regulations to protect consumers while fostering innovation. Other countries, like China, have banned cryptocurrencies outright. The regulatory landscape is constantly evolving, with governments around the world working to find a balance between encouraging innovation and protecting consumers from fraud and financial instability. It's essential to stay informed about the legal status of cryptocurrency in your country, especially if you're planning to invest or trade. Cryptocurrency has opened up new possibilities for financial inclusion, allowing people who don't have access to traditional banking services to participate in the global economy. For people in countries with unstable currencies or restrictive governments, cryptocurrency offers a way to store and transfer wealth without interference. This potential for financial freedom has made cryptocurrency particularly appealing in regions with high inflation or limited banking infrastructure. In conclusion, cryptocurrency is a fascinating and rapidly evolving technology with the potential to transform the way we think about money and value. From Bitcoin's creation in 2009 to the rise of Ethereum and other altcoins, the crypto space has grown significantly, attracting millions of users worldwide. Whether you're interested in using cryptocurrency as an investment, a means of payment, or a technology for innovation, understanding the basics is the first step. While the world of crypto can be complex and sometimes risky, it also offers exciting opportunities for those willing to learn and adapt. Finance is a broad field that touches every aspect of our lives, whether we realize it or not. Understanding finance doesn't just mean having more knowledge about numbers, it's about equipping yourself with the tools to make better decisions, grow your money, and achieve your goals. Let's start with the basics and break down what finance really means. In its simplest form, finance is the management of money. It involves activities such as investing, borrowing, lending, budgeting, and saving. The goal of managing finances is to ensure that money is used in a way that maximizes its value. When we talk about finance, we're usually referring to three main categories: personal finance, corporate finance, and public finance. Personal finance is the area that affects each of us directly. It involves managing your own or your family's money, including budgeting, saving, investing, and planning for the future. Corporate finance, on the other hand, deals with how companies manage their funds, while public finance refers to how governments handle money through taxes, spending, and borrowing. Personal finance is a crucial part of managing money on an individual level, and understanding its basics is essential for everyone. This involves making a budget, tracking expenses, and understanding your income and spending habits. The foundation of personal finance is built on creating a budget, which is essentially a plan for how you're going to spend and save money. A budget allows you to know where your money is going, helping you avoid unnecessary expenses and stay on track with your financial goals. Another key part of personal finance is saving. Building a habit of saving money can make a huge difference over time, even if you start small. Saving is not just about setting aside extra money when you have it, it's about making it a priority. An emergency fund is an important type of savings that serves as a safety net. It's money you set aside to cover unexpected expenses like medical bills or car repairs, and having this cushion can keep you from going into debt when surprises happen. A general rule of thumb is to aim for 3 to 6 months worth of living expenses in your emergency fund. Investing is another crucial component of finance that many people find intimidating, but it's essential for building wealth. Unlike saving, where your money remains idle in a bank account, investing allows your money to grow over time. There are different types of investments, such as stocks, bonds, real estate, and mutual funds, each with its own risk and return. Stocks, for instance, represent a share in a company, and when you buy stocks, you're buying a piece of that company. While stocks can offer high returns, they also come with higher risk. Bonds, on the other hand, are loans that you give to a company or government, which will pay you back with interest over time. Bonds are generally considered safer than stocks but usually offer lower returns. Mutual funds pool money from multiple investors to buy a diversified mix of stocks, bonds, or other securities, allowing you to invest without having to pick individual stocks or bonds. Diversification is a key concept in investing, which means spreading your money across different types of assets to reduce risk. Instead of putting all your money in one place, you spread it out to minimize the impact of any single investment going bad. Debt is another big topic in personal finance, and while it can sometimes be necessary, it's something that needs careful management. Debt is money that you owe, and it can come in many forms, such as credit card debt, student loans, and mortgages. While some types of debt, like a mortgage, can be considered good debt because it helps you acquire assets like a home, other types, like high-interest credit card debt, can be very damaging. When taking on debt, it's important to consider factors like the interest rate, loan term, and your ability to make timely payments. High-interest debt can quickly spiral out of control, as the interest compounds over time, making it harder to pay off. Paying down high-interest debt should be a priority in your financial plan, as it can help you save money in the long run. Let's now look at the concept of credit, which is closely related to debt. Credit is essentially a measure of how trustworthy you are with borrowed money. A credit score is a numerical rating that represents your creditworthiness, and it's based on factors like your payment history, the amount of debt you owe, and the length of your credit history. A good credit score can open doors to better loan terms, lower interest rates, and even job opportunities in some cases. Maintaining a good credit score involves paying bills on time, keeping your debt levels low, and being cautious about taking on new credit. If you're just starting out, one way to build credit is by getting a credit card and using it responsibly. Pay off the balance in full each month to avoid interest charges, and keep your credit utilization rate, the percentage of available credit you're using, low. This shows lenders that you can manage credit well and are a low-risk borrower. Now, let's talk about one of the most exciting aspects of personal finance, building wealth. Building wealth isn't just about earning more money, it's about making your money work for you. One way to build wealth is through compound interest, which is when you earn interest not only on your initial investment but also on the interest that accumulates over time. Compound interest can significantly grow your wealth if you start investing early. Another important concept in wealth building is the idea of assets and liabilities. Assets are things that put money in your pocket, like investments, real estate, and businesses, while liabilities are things that take money out, like loans and other debts. The key to building wealth is to acquire more assets than liabilities. Taxes are an unavoidable part of personal finance, but understanding how they work can help you keep more of your hard-earned money. Taxes are collected by the government and used to fund services like roads, schools, and healthcare. There are different types of taxes, such as income tax, sales tax, and property tax. Income tax is a percentage of your income that you pay to the government, and it varies depending on your income level. Learning about tax deductions and credits can help reduce your tax bill. For example, if you're saving for retirement through accounts like a 401k or an IRA, you may be eligible for tax advantages. Some people also benefit from hiring a tax professional or using tax software to make sure they're not overpaying. Finally, planning for the future is an essential part of personal finance. Retirement may seem far off, but the sooner you start planning, the more secure you'll be when the time comes. Retirement accounts like 401(k)s and IRAs are designed to help you save for retirement, and they often come with tax benefits. Many employers offer matching contributions to a 401(k), which is essentially free money for your retirement. Social Security is another source of retirement income, but it's not enough to fully support most people, so it's wise to have other sources of income as well. Another aspect of planning for the future is having insurance, which provides financial protection against unexpected events. Health insurance, life insurance, and property insurance can help protect you and your loved ones from financial hardship. Life insurance, for instance, ensures that your family is financially protected in case something happens to you, while health insurance can cover medical expenses. Estate planning is another part of financial planning, especially as you accumulate assets. Estate planning involves deciding how your assets will be distributed after your death. Creating a will, assigning beneficiaries, and setting up trusts are some of the steps involved in estate planning. This ensures that your loved ones are taken care of and that your assets are distributed according to your wishes. Even if you don't have significant assets now, it's a good idea to consider estate planning as your financial situation grows. In summary, understanding finance is about knowing how to manage your money effectively, make informed decisions, and plan for the future. By learning about budgeting, saving, investing, managing debt, building wealth, and planning for retirement, you're taking steps toward financial independence and security. Finance may seem complicated at first, but with time and dedication, anyone can master the basics and take control of their financial future. Whether you're just starting out or looking to improve your financial situation, the key is to keep learning, stay disciplined, and be patient. Financial success doesn't happen overnight, but with the right knowledge and habits, you can build a secure and prosperous future for yourself and your loved ones. Building wealth on a low income may seem challenging, but it's absolutely possible with the right approach, discipline, and mindset. Many people have managed to turn modest earnings into significant savings and investments by focusing on consistent habits, smart budgeting, and strategic financial decisions. Achieving financial success on a low income doesn't happen overnight, but with careful planning, you can create a solid foundation that grows over time, allowing you to live comfortably and build the wealth you need for a secure future. One of the most effective ways to begin building wealth on a low income is by setting clear financial goals. Goals give you a direction and help you prioritize where you spend and save. It's easy to feel that saving money isn't feasible when your income is limited, but by having a specific target, like saving for an emergency fund, paying off debt, or putting aside money for retirement, you create a purpose for every dollar you earn. Start by defining both short-term and long-term goals. Short-term goals could include saving a few $100s for an emergency, while long-term goals might include saving for a home or retirement. When you have a goal, it becomes easier to make decisions that align with your priorities, even if it means making small sacrifices in the short term. Budgeting is another essential tool for building wealth, and it's even more critical on a low income. A budget allows you to see exactly where your money is going and helps you identify areas where you can cut back. Begin by listing your essential expenses like rent, utilities, food, and transportation. Then add up your discretionary expenses like dining out, entertainment, or non-essential shopping. Seeing these categories in black and white can be eye-opening, as it shows where money may be slipping through your fingers. With a budget, you can make adjustments to ensure that you're not overspending in any one area, allowing you to allocate more towards savings and investments. Sticking to a budget can feel restrictive, but it's one of the best ways to make sure you're living within your means and moving toward your financial goals. Living below your means is crucial when trying to build wealth on a low income. This doesn't mean depriving yourself of every comfort, but it does mean being mindful of spending and prioritizing needs over wants. Avoiding lifestyle inflation, or the tendency to increase spending as income grows, is key. For instance, if you receive a bonus or tax refund, resist the urge to spend it all immediately. Instead, consider putting a portion into savings or investing it. Living below your means allows you to save more money, and each dollar you save brings you one step closer to financial security. Even small adjustments, like cooking at home instead of dining out or finding affordable entertainment, can make a difference. Another effective wealth-building strategy is paying yourself first, even on a low income. This simply means prioritizing savings before spending on non-essentials. When you receive a paycheck, immediately set aside a portion for savings or investments before paying bills or discretionary spending. Even if you can only set aside a small amount, it's the habit of consistent saving that counts. Automating your savings by having a portion of your paycheck directly deposited into a savings account can make this process even easier. When you pay yourself first, you're treating your financial future as a priority, building a habit that reinforces your commitment to wealth building. Even if it's gradual, saving money doesn't always mean giving up what you enjoy. It can also be about finding ways to enjoy life without spending a lot. Embracing a frugal mindset helps you get more value for every dollar. Look for ways to save on necessities, like buying groceries in bulk, cooking meals at home, or purchasing items on sale. Many people find that by planning meals, shopping with a list, and using coupons, they can save a significant amount on food expenses each month. When it comes to entertainment, explore free or low-cost options like community events, public parks, or hobbies that don't require a big financial investment. Living frugally doesn't mean you never spend money. It means spending mindfully so that every dollar works towards your goals. Eliminating debt is another critical step toward building wealth. Debt, especially high-interest debt, can hold you back from reaching your financial goals. On a low income, it's easy to fall into the trap of relying on credit to cover expenses, but the cost of interest can quickly add up, reducing the amount you can save or invest. Start by prioritizing paying off high-interest debts, like credit card balances, as quickly as possible. Once high-interest debt is under control, focus on paying down other debts. The less debt you have, the more of your income you can put towards building wealth. If debt is a major concern, consider talking to a financial advisor or credit counselor for personalized strategies to manage and reduce it. Investing, even in small amounts, is a powerful tool for building wealth over time. It's easy to think that investing is only for people with substantial savings, but the truth is, you can start investing with just a few dollars. Many investment platforms and robo-advisors allow you to start with minimal amounts, offering options like stocks, bonds, and index funds. By investing early, even on a low income, you take advantage of compound interest, which allows your money to grow over time. The key is to start small and invest consistently, making the most of the time you have for your investments to grow. Even if your contributions are modest, the habit of regular investing can significantly impact your financial future. Increasing your income through side hustles or skill building is another effective strategy for building wealth. While saving and budgeting are essential, sometimes the best way to grow your wealth is to increase the amount of money coming in. Many people on a low income have found success by taking on side hustles, like freelancing, tutoring, or selling handmade goods online. Others have invested in developing new skills that open up opportunities for higher-paying jobs or promotions. Learning new skills doesn't always mean going back to school. It can involve taking online courses, networking, or volunteering in areas that allow you to gain experience. By increasing your income, you have more resources to put toward savings and investments, accelerating your journey toward financial security. Avoiding common financial traps can also help you build wealth on a low income. Credit card debt, payday loans, and high-interest installment plans may seem like convenient solutions when money is tight, but they can lead to cycles of debt that are difficult to escape. Try to avoid using credit cards for everyday purchases unless you can pay the balance in full each month. Building an emergency fund helps you avoid going into debt for unexpected expenses, and sticking to a budget ensures you're not spending beyond your means. By being mindful of these financial traps, you protect yourself from unnecessary expenses and keep your financial goals on track. Building an emergency fund is essential, even on a low income. It might seem challenging to set aside money when you're just getting by, but an emergency fund provides a safety net that can prevent you from falling into debt when unexpected expenses arise. Start by setting a small goal, like saving $500, and build from there. Even if you're only able to save a few dollars a week, it will add up over time. Having an emergency fund in place gives you peace of mind, allowing you to handle life surprises without derailing your financial progress. Lastly, cultivating a positive mindset about money is key to building wealth on a low income. It's easy to feel discouraged or think that financial success is only for high earners, but wealth building is about consistency and discipline, not just income level. Celebrate small wins, like reaching a savings goal or paying off a debt, and stay focused on your long-term goals. Recognize that financial success is a journey, not a race, and that every step you take brings you closer to your dreams. By believing in your ability to manage money effectively and create wealth, you empower yourself to make choices that support your financial well-being. In conclusion, building wealth on a low income requires intentional actions, strategic planning, and a commitment to consistent effort. By budgeting effectively, living within your means, prioritizing savings, investing regularly, and staying focused on your goals, you can create a financial foundation that grows over time. Small steps, like paying down debt, setting up an emergency fund, and finding ways to increase your income, can have a lasting impact on your financial health. The journey may have challenges, but with patience, discipline, and a clear vision, you can achieve financial security and set the stage for a prosperous future. Remember, building wealth is not about how much you earn, it's about how well you manage and grow what you have. Every positive choice you make today will pay off in the future, bringing you closer to the financial freedom you desire.